Welcome back to Talk Tickers. This is the show where we cut through the noise of earnings season to bring professional investors the summaries that, actually matter.
We don't just read the press release.
No, we read between the lines. I'm your host, and today we are looking at a ticker that has taken investors on a serious roller coaster. We're talking about Stride Inc., ticker symbol LRN.
Good to be here. And roller coaster is, maybe putting it mildly, Stride is that tech-enabled education company. And coming into this print, the stakes were just incredibly high.
Exactly. Let's set the stage a little. The prior quarter was, for lack of a better word, a disaster.
A total mess.
They had a botched platform rollout, major technical issues, parents couldn't log in, the stock got hammered. So the big question for this Q2 fiscal 2026 print was simple. Is the bleeding stopped?
Is the tech actually fixed, or is this, a structural failure?
That was the fear, right. The whole bear case was that these technical problems would lead to just a mass exodus of students.
Right, that come the second semester, parents would just give up. But we got the answer pretty much immediately from the market.
We certainly did. Let's just look at the tape. Stride closed the day before at 72.43. Post-earnings, it just gapped up. Massive.
Where'd it go?
We're looking at a jump to 82.75. That's up $10.32. A 14.25% gain in one session.
And the volume confirmed it.
Oh, yeah. Massive spike. 6.7 million shares traded. That's what, 4.5 times the previous day's volume?
When you see a price jump like that on volume like that, it's telling you one thing. The shorts are capitulating, and there's a huge rush of relief buying. This is a de-risking event.
So the market's verdict is in. This wasn't a dead cat bounce. This was a proof of fixed turnaround. Our mission today is to dig into the Q2 results and figure out how they pull this off.
And what the rest of the year looks like.
Okay, let's hit the headline numbers first. Rapid fire.
Let's do it. Revenue came in at $631.3 million. That's up 7.5% year over year.
And that beat consensus.
Beat it slightly, yeah.
Okay.
By about $3.4 million. But the real story, I think, was further down the income statement.
Okay.
Adjusted operating income hit $159 million, up over 17%. Adjusted EBITDA, $188.1 million, also up about 17%.
And the big one, the EPS number everyone was watching.
Non-GAAP adjusted EPS was $2.50.
$2.50. Wow. The consensus was sitting at what, $2.01?
Exactly. So they beat by a massive 49 cents. That's a 24% beat on the bottom line.
I did see some noise in the sell-side notes about GAAP versus adjusted numbers.
There always is with Stride, with stock-based comp and amortization. But honestly, the market just completely ignored it.
Right.
The volatility premium going in was huge. Options were expensive. And that premium just collapsed into a rally. The market cared about one thing. Did enrollments fall off a cliff?
And the answer?
The answer was no. Total enrollments sat at 248.5 thousand. Up almost 8% year over year.
Okay, so let's unpack the narrative here.
Yeah.
Because the numbers are great, but the story is survival and stabilization. We have to talk about the platform, the elephant in the room.
CEO James Raiu, he didn't mince words on the call. His primary message was, and I'm quoting here, "Core issues are behind us."
That's the sentence they needed to hear.
It is. But he didn't just say it, he gave a metric to back it up. He said after they fixed a major login issue, customer support call volumes dropped over 90%, week over week.
90%. That's a staggering drop. It shows you how acute the pain was, but also how decisive the fix must have been.
It implies it was one big bottleneck causing all the noise. And qualitatively, he also mentioned that complaints on social media have just fallen off a cliff.
Which, if you follow these companies, that's a huge leading indicator for churn. When parents are mad, they go to Twitter. Silence is golden.
For sure. It's also interesting to hear about their strategy shift on the tech stack. They basically admitted the old legacy platforms, which were like 20 years old, just had too much technical debt.
Yeah, it sounded like they were trying to modernize the engine of a car while it was speeding down the highway.
Right. So they moved to third-party platforms, which caused the initial headache. But now Raiu is talking about building a proprietary architecture on top of that.
So they control their own destiny.
Exactly. Have redundancy. Don't be beholden to a single vendor. It's an expensive pivot, but it's probably necessary if they want to scale without breaking again.
Okay, now here's where it gets really interesting to me. Usually, a growth company has this kind of recovery. They come out swinging, right? We're back. We're going to double revenue.
Yeah, promise the moon.
But Stride is doing something really counterintuitive. I'm calling it Strategic restraint.
I like that, the throttle logic. Despite really strong demand, they are explicitly not chasing growth for the rest of this year.
The CEO's quote was basically, "Our goal this year is stability, not growth."
Which you could tell drove some of the analysts nuts in the Q&A. I think it was Greg Parrish from Morgan Stanley who asked, if demand is so high, why aren't you growing?
It's the classic Wall Street mindset. If the money's there, take it.
It's a fair question from a spreadsheet perspective, but from an operational one, Raiu's answer was spot on. He said it would be short-sighted to hit the gas right now. They've got to rebuild trust first.
So they're actually turning people away,
Yep.
waitlisting them.
Yep, intentionally turning away mid-year enrollments or putting them on a list for the fall.
Think about the discipline that takes. You have customers at the door, wall it out, and you say, "No, not yet. Come back in 6 months."
It signals a management team that's thinking about the next 5 years, not the next quarter. They know if they bring in another 10,000 kids and the system crashes again,
They're done.
permanently, the brand damage would be irreversible. So they're trading short-term revenue for long-term viability.
Let's talk about those families, the customers. The biggest bear thesis was that Q2's tech mess would cause a wave of withdrawals in Q3.
That was the cliff everyone feared. Okay, we suffer through the fall, but come January, we're out. But it didn't happen.
No cliff.
No cliff. January withdrawal rates are back to historical norms. They successfully backfilled the attrition.
Raiu used a really powerful word to describe the families. He said they were gritting through the pain.
That really struck me too. He said he talked to families who were frustrated, but basically told him, I am willing to bear this pain because I desperately need this alternative.
It just highlights how sticky the product is.
It's not a casual thing. These are families where the traditional school system has failed them for whatever reason. Stride is a lifeline. That status gives them a moat that even these technical glitches couldn't breach.
That's a huge point. It's a utility, not a luxury. Okay, so the core business is stable. Let's dive into the segments because the growth engine seems to be shifting.
It is. The exciting part of the thesis is career learning, middle and high school programs. Revenue there grew 29%.
29%. That's tech stock level growth.
It is. And it's so important because it shifts their addressable market beyond just, I need to do school at home.
Right. It's about, I want to learn a trade, get a skill.
Exactly. You're not just getting a diploma, you're getting certified in healthcare or IT. Meanwhile, general education or gen ed revenue was actually down 3.6%.
Was that alarming, seeing the core business shrink like that?
Not really. It was mostly mix and some state funding timing, but it clarifies the future. Gen Ed is the cash cow, it pays the bills. Career learning is the star. That's where the alpha is.
Got it. Let's talk margins again. Gross margin hit 41.1%, up 30 basis points. But the CFO, Donna Blackman, she flagged an asterisk there.
She did. And credit to her for the transparency. She noted a roughly 200 basis point benefit from a one-time gain.
This is that legacy real estate, right? The boot camp lease.
Exactly. They exited a long-term lease for a non-core business. So while the gain is one time from an accounting perspective, getting that expense off the books is a permanent benefit.
So it's not just a trick, it's a structural cost removal. They cut dead weight.
Precisely.
Okay, so looking ahead, what do they do with guidance?
They reaffirmed the full-year revenue range, so that's $2.48 to $2.55 billion. That says they're confident they can hit the target even with the throttle on.
But they raised profit guidance.
They did. They raised the floor on adjusted operating income, now looking at $485 to $505 million.
They also warned about seasonality,
Right.
which I think is key for anyone holding the stock.
Super important. Historically, Q4 is the heavy hitter. This year, because of these enrollment patterns, Q3 and Q4 are going to be more evenly split, so investors shouldn't panic if Q3 looks a little different than the historical trend.
Okay, let's zoom out. Investor context. The stock is up, what, almost 34% in the last month? A massive reversal.
It is, especially with the S&P being basically flat. This is the market rewarding a scaled operator who proved they can fix a huge mistake. It's them saying, okay, you tripped, but you got back up.
Raiu shared that anecdote about visiting a potential new state partner, which I thought was really telling.
It was. He's in a state capital. The headlines have been bad, and you'd expect the potential partner to be skeptical. But he said there was no hesitation. They want to sign.
So the mission alignment outweighs the technical glitches.
It proves the demand is organic and political, not just consumer-driven.
Which brings up a great point on marketing. They actually lowered marketing spend SG, and A was down almost 2%. And yet,
application volumes are matching last year's record highs.
that's the definition of leverage.
It is. When you can spend less on ads and still get the same number of customers, you have a powerful tailwind. They aren't buying growth. The growth is coming to them,
Their customer acquisition costs must be plummeting.
which flows directly to the bottom line.
Okay. We've covered the numbers, the turnaround, the strategy. Now it is time for our favorite segment.
The lawyers are going to love this part.
They always do. This is not financial advice segment. We pitch a trade idea based on the subtext of the call. It's wild. It's speculative. What do you have for us?
Okay, I'm calling this trade the coiled spring. Or maybe the marketing arbitrage play.
I like coil spring. It sounds explosive. What's the thesis?
Okay, here's the logic. We've established that Stride is currently and actively suppressing its own growth. They are waitlisting kids. They are cutting marketing.
Driving with the parking brake on purpose?
Exactly, driving with the brake on because they don't want to crash the car again. Safety over speed.
Yeah.
But the engine is revving. Demand is outstripping supply organically.
We know that from the application volumes.
Right, so the trade is this. Long LRN. And if you want a pair trade to hedge it out, short the traditional ed publishers who are stuck in declining models.
Why now? Why not wait until they actually take the brake off?
Because the market is forward-looking. The moment Stride signals the tech is fully safe, probably leading into the fall of fiscal 27, they are going to release that brake. They'll turn the marketing spigot back on, open the enrollment gates.
And the numbers could be explosive.
They could shock the market to the upside. Because they've spent this entire year fixing the plumbing and optimizing costs, the incremental margin on those new students will be higher than ever.
So you're buying the suppression today
Yeah.
to sell the explosion tomorrow.
That's it. You're buying a company that's artificially capping its own revenue. When the cap comes off, the valuation re-rates. It's an asymmetric risk profile, but you have to be patient.
I love it. Betting on the inevitable release of pent-up pressure. Again, not financial advice. Just a read on the situation.
Absolutely. Do your own charts.
So to wrap this up, Stride navigated a crisis. The tech is stable. Withdrawals are normal. Career learning is booming. And the stock has reacted with a massive vote of confidence.
The company is trading growth for trust this year. They're doing the hard, boring work of fixing the foundation so they can build the skyscraper later.
And the question for you, the listener, is simple. Do you have the patience to wait for that growth to come back online next year? Stride has bought itself time.
Now they have to use it. Execution is everything. We'll be watching that Q3 print very closely.
Thanks for listening to Talk Tickers. Do your own diligence, check the charts, and we will see you on the next print.
Good trading, everyone.